I was recently approved for a $50,000 line of credit. What's up, YouTube? Welcome to the Credit Plug channel where we talk about how to build credit, how to establish relationships with banks, and most importantly, how to get you access to high limit credit funding. If you haven't already, make sure you hit that subscribe button as well as smash the like button. So in today's video, I'm gonna be sharing some data points on a recent business line of credit that I was able to get approved for $50,000. I'm gonna be sharing some insights just to kind of explain the process that I actually had to go through, the documentation, and the different data points that I had to provide. So before we get into today's video, I just want to explain exactly what a business line of credit is, because sometimes you might hear credit lines, credit cards, lines of credit. Now, there is a distinct difference between a line of credit and a credit card. So some of the similarities, they are both revolving, but one of the key differences is that a line of credit is going to give you better access to liquidity or cash access, whereas a credit card isn't going to give you as much liquidity. So let's say, for example, you wanted to get cash off of a credit card. Typically, what you can do is what's called a credit card cash advance. However, the interest rates are very high, sometimes in the 20% range when you're taking a cash advance. And on top of that, you can't really take the full amount using a cash advance. Now, there's new services out like Plastique, where basically for a fee about 3%, they'll either send an ACH deposit or write a check to whoever you're looking to pay. But with a line of credit, you can draw down the entire amount, meaning that you could transfer the full amount of the line of credit directly to your checking account. And from your checking account, you're able to withdraw that money or use that money however you wish. One of the major distinctions is that a line of credit does not have a grace period, unlike with a credit card. So for example, with credit cards, if you pay the balance off in full before the end of the statement cycle, then you're not going to incur any interest. So it's possible to utilize credit cards without actually having to pay interest. So with the line of credit, there is no grace period. As soon as you use the line of credit or draw down on it, you're going to get hit with interest. So that's one of the major differences. And in terms of the interest rates, right? So the line of credit interest rates typically are going to be lower than a credit card interest rate. Now, that could vary from different institution to institution, but typically, let's say when we're talking about personal lines of credit, the interest rate is usually going to be lower than a credit card. So if we're talking about in order of different credit products, term loans are usually going to be the lowest interest rates, then lines of credit, and then credit cards are going to have the highest interest rates. There's also a difference in how you might actually use a line of credit versus a credit card. A credit card, I would say, would be more for short-term types of transactions and expenses, where a line of credit, it might be, let's say, 30 to 90 days out. And with a term loan, it's going to be even longer time periods. So depending on what you plan to use the funds with, that might actually dictate what type of product that you want to utilize. So again, a line of credit is probably going to be like intermediate, like 30 to 90 days. You also got to take into account the interest rate, right? Because with a line of credit, you can't avoid paying interest. As soon as you use it, you're going to incur interest. So you really have to be strategic about how you plan on using the line of credit. So recently I was able to get approved for a business line of credit with a $50,000 credit limit. But before we dive into the data points, I wanted to give you an overall view of the business line of credit landscape. So where you could actually get different business lines of credit and some of the considerations that you might want to consider before applying for different business lines of credit. So at a high level, you have the alternative lenders. So these are going to be the Blue Vines, the OnDecks, the Fundbox, Idea Financial. Then you have commercial banks, and I would even throw credit unions in here as well. So you have, for example, Navy Federal, you have Truist, you have Bank of America, Wells Fargo, all of the major banks. And then you have SBA, so the Small Business Administration. Now, there are some considerations and trade-offs that you have to consider when applying for different business lines of credit, because there's different requirements, different types of documentation, different interest rates, the speed at which you could actually get funding, the approval difficulty, as well as whether or not you're getting hard pool. So I just wanted to go over some of the differences. Now, the first thing I wanted to talk about is documentation. So with a lot of the alternative lenders, the documentation is going to be very low, meaning that usually they can approve you with just your credit score, so a soft credit inquiry, as well as just linking to your banking activity or plugging into your QuickBooks account. That's why I always recommend that you get an accounting software, whether it's QuickBooks or any other type of software, because all of your business information is already integrated and you don't really have to supply additional documentation like profit and loss or balance sheets because it already plugs into your accounting software. Now, when it comes to commercial banks, they're going to require a lot more documentation. So the commercial banks, generally, they're going to want to see business bank statements. They're probably going to also want to see your CPA prepared tax returns. They may also want to see profit and loss statements, balance sheets. And then with SBA, they even go a step further because the SBA may also want to see a business plan or even resumes of all of the business owners, as well as, seeing your credit report, seeing your business credit report. So in terms of documentation, alternative lenders is going to be the lowest documentation. So I know a lot of people don't really like providing a lot of documentation. So if that's the case, an alternative lender might be a good fit for you. Now, one of the other considerations is interest rate. So I know recently a lot of people have gotten these EIDL loans as well as PPP loans with like 3% interest rates. Now, that's probably the best you're going to get. Like, you're not going to get 3% at alternative lenders or even at commercial banks. Now, alternative lenders, the interest rates can be extremely high. So I wanted to show you this real quick. So this is just to show you kind of the landscape of the different sources of business lines of credit. Now, as you can see down here, you have like a Cabbage, which is 80 to 120% APR. OnDeck, Blue Vine, 45% APR. And then over here, you have some of the commercial banks, which is around 10% or lower. So there's definitely a trade-off. So the alternative lenders are going to have very high interest rates. The commercial banks, I would say those are going to be pretty moderate. You might expect anywhere around like 9 to 10% or higher. And then with the SBA, of course, you're going to get the lowest interest rates, but you're not going to get 3% at commercial banks, and you're definitely not going to get 3% at alternative lenders. So that's one consideration that you should keep in mind when you're looking to get a business line of credit. One of the other considerations is the speed of funding. So alternative lenders are going to have the fastest turnaround in terms of your application and underwriting. So if you need quick access to funds, alternative lenders is going to be better than even going to commercial banks or SBA. Now, with commercial banks, generally this could take weeks. In certain situations, if you already have a banking relationship, they may be able to get you approved within a matter of days. Now, I could say with Truist, which I also have another business line of credit, that took about a week in order to get an approval for that. And then the SBA, of course, can take months. Now, I know a lot of people got these EIDL and PPP loans very quickly, but in some cases, it still took months or weeks. And traditionally, with other SBA programs like the Community Advantage or the 504 SBA loans, that can take months. The other consideration that I know a lot of small business owners consider is whether or not you're going to get a hard inquiry on your credit report. Now, fortunately, with a lot of alternative lenders, they're not going to be hard pulling you. They're just going to be doing a soft pull on your credit. So that's a huge advantage. With commercial banks, they're always going to hard pull you. And then with the SBA, they're also going to hard pull you. So those are the disadvantages, I would say, with the commercial banks and the SBA. In terms of approval difficulty, now the alternative lenders, it's going to be, I would say, moderate. Now, alternative lenders are going to look more so at your cash flow, and the credit score requirement is going to be much lower. So a lot of them have credit score requirements as low as like a 550 or even like a 600 credit score. With commercial banks, it's going to be much higher. Usually they're looking for prime credit. So you're going to have usually over a 680 FICO score in order to qualify. And then the SBA, I would say, is moderate approval difficulty. You're still going to need to have all of the requirements, so credit score and income, but it's not going to be as difficult as going to a commercial bank. So in terms of approval difficulty, going to the major banks is going to be the most difficult. And then in terms of the length of the term, Alternative lenders are going to be the shortest terms. Commercial banks, you could get lines of credit out to 36 months. And then SBA, they have much longer terms. So these are just some of the considerations that you have to take into account when you're applying for different lines of credit with different lenders. So don't apply for an alternative lender and then complain about the APR, or apply for a commercial bank and then complain about all the documentation. These are the trade-offs that you have to take into consideration. So a couple days ago, I got approved for a business line of credit with OnDeck. Now, OnDeck is an alternative lender, so they have a line of credit as well as term loans. So the lines of credit go anywhere from $6,000 all the way up to $100,000 with a 12-month repayment term, and it resets after each withdrawal. And then they also have term loans, $5K all the way up to $250,000 with repayment terms out to 24 months. Now, the qualifications, you have to have at least a 600 FICO score. So they're going to be soft pulling all three of the major credit reporting agencies. And you also need to be in business a minimum of 1 year. And then the requirement in terms of annual gross revenue is $100,000. And you're also going to need to have a business checking account. Now, one other thing I will say is that during the application process, they also have you plug into your banking activity through Plaid, and you also will have to plug in through your accounting software. So that's why I'm always encouraging you guys to get set up with QuickBooks, because a lot of alternative lenders, because they're able to give you a fast decision, they're plugging directly into that data. They're able to analyze and underwrite that data very quickly. So if you want to get fast access through some of these alternative lenders, you definitely want to make sure you have a business checking account as well as an accounting software that they can plug into and pull all your information in. All right, so here I'm logged into my OnDeck account, and I was recently approved for a $50,000 line of credit. Now, in order to utilize this, all you have to do is click this draw funds button. And then on this page, it allows you to draw the funds directly from the OnDeck line of credit to your checking account. So it takes about 1 business day for the funds to hit your account. And then at that point, that's when the interest starts to kick in. Now, the minimum draw amount is $1,000, and it's limited to only 1 draw per day. And once you repay this, the line of credit replenishes itself. So it is a revolving line of credit. Now, on this page, they show you the line of credit amount and how much you have available and your transaction history. Now, as you can see, I don't have any transaction history because I have yet to actually utilize the line of credit. And so, again, the line of credit, I would say, is very advantageous versus, let's say, a term loan, because if you don't know exactly how you plan to use it, then you don't have to incur interest, versus a loan. When you take out a loan, you're going to be paying interest immediately. Now, the trade-off is that a loan is going to have a lower interest rate in APR than a line of credit. So depends on the flexibility. If you have an immediate use of funds, then you might be better off with applying for the loan. And one other thing I will say is that the loan amounts typically are going to be higher. So during the application process, I was actually offered a $50,000 line of credit as well as an $85,000 term loan. So I decided to only accept the $50,000 line of credit. I did not accept the $85,000 term loan because I don't have a need for $85,000 term loan just yet. Now, one thing I will say about the entire application process is that I actually did submit a lot more documentation than what they described on their website. So when you go through the application process, you do plug into Plaid, so they get your real-time banking activity, but you also have to upload the last 3 months of your business bank statements. And on top of that, you also do plug into your accounting software. So I also had to plug into QuickBooks. Now, when I went through the process, they actually combed through a lot of the individual transactions within my business bank account. So they were really drilling into like specific questions, and they actually went as far back as a year, just like asking me questions about certain transactions, certain transfers. So although the application says, 3 months of bank statements, the underwriters can use their own discretion and, question you on any little detail within your business. Now, I actually almost got denied for this line of credit because the underwriters were questioning why I actually needed the line of credit, because obviously they could look into your credit and see all the different lines of credit cards that I already have, as well as see the amount of money in my checking account. So they actually were asking me why I actually needed the line of credit. But, I just explained, hey, I just want to have this just in case I plan on using it and keep my cash reserves just as an emergency, but use the bank's money. So I explained that. And then they were also questioning me about the difference between my revenue and expenses. So as a consulting business, having a YouTube social media business, overhead is very low, right? I just have equipment, subscriptions in relation to the amount of money that comes in every month. So they were basically saying that that doesn't look like a typical business that earns that amount of revenue per month, usually has much higher expenses. So they were drilling me on that, which I found, pretty bizarre and actually a little bit uncomfortable. I don't think they really understood kind of, the business model, and they did infer based off of, other data points that they seen that it looked a little suspicious why there weren't as many expenses in relation to the amount of revenue coming in. In addition, the underwriter also requested that I provide a 2020 tax return. Now, this wasn't part of the application process. This was just additional information that the underwriter requested at their own discretion. So that's just one thing I would caution just going through this process, that they may require more documentation than what the original application is actually requiring. Because again, the original application just asks for the last 3 months of bank statements, but the underwriter also requested for 2020 tax returns, right? So it's 2022, right? So I also provided 12 months of bank statements for 2021, 2020 tax returns, and I also provided the last 4 months bank statements of 2020. So it was a lot more documentation than they actually stated in the application. And I was actually pretty surprised that, I had to provide so much documentation. I did get approved for a $50,000 line of credit, but just based off my data points, amount of revenue, as well as credit. So I assumed, there would be no issues, but it was interesting that they actually wanted to see a lot more information. That actually caught me off guard. But again, I probably won't even use this line of credit. A lot of what we do on this channel is just for research, just so that you can understand the process, what data points they're actually looking for. So I hope this video was helpful. Let me know your comments and questions in the comment section down below. And until next time, take it easy, and we'll talk to you soon. Peace.